Hi guys, welcome back to Father and Son Investing. I came across an interesting article this morning in the Wall Street Journal that will be applicable for tomorrow, February 12th, when the CPI data comes out. So here's the headline: why this week's inflation report is especially important. Why might this be important for people who own US Treasuries? We're going to talk about this article and some of my thoughts. So let's get started. Most of you are probably aware that the Consumer Price Index, otherwise known as CPI, comes out monthly. But the January report, which comes out in February of each year, packs a particular punch. Why is that? Well, you may or may not be aware that the Consumer Price Index, which comes from the Bureau of Labor Statistics, is revised annually. At least the seasonal adjustment factors are revised annually. And so that first report for January of 2025, which will come out in February, can have a particular effect upon the way that inflation is being perceived, particularly within the first quarter of each year. Here's a look at what I'm talking about graphically. If we look here, you'll see the various years from 2022 to 2024 in their respective colors. Notice that at the end of 2022, the month-over-month CPI was 0.17. But when we come to the first month of 2023, so for January, it was 0.62. That's a significant increase. Let's look at 2023. At the end of 2023, 0.1%, and yet at the start of 2024, 0.55%. Again, this jump looks significant. Part of that has to do with the revised Bureau of Labor Statistics CPI seasonal adjustments. But there's another factor here. What is that? Well, the beginning of the year is a natural time for businesses to increase prices. If you have a membership somewhere, that price may increase in January. Likewise, if you have a subscription to something, that price a natural time to increase would be January. What else gets passed along in January? Well, businesses who have been absorbing the increased costs of labor or materials tend to pass those things along in January. So between the CPI being adjusted and just a natural increase in prices that will occur in January of each year, this first report that will come out tomorrow may have a significant impact if you are a US Treasury buyer. On Thursday of this week, the lesser known of the two reports, the PPI or Producer Price Index, will come out, and that will give us an idea of what inflation looks like for manufacturers. Between those two reports, we may see a significant change in what U.S. bond yields look like. Now, before I give my opinion of what I think may happen with U.S. bond yields depending on this report, let's just look at what the expectations are for inflation. This comes from the Cleveland Fed Inflation Nowcasting website. Their prediction for January 2025 is that the month-over-month CPI will come in at 0.24% and the core CPI at 0.27. And just by the way, they also give you a running idea of what they think for February, looking like roughly the same numbers coming out for the February report in March. So if we see numbers significantly higher than this, what might happen? Well, my thought is that the market will react by an increase in the yield on the 10-year Treasury note, or otherwise a decrease in the price, and likewise really with all of the notes 2 to 10 years. Now, my opinion, if these inflation numbers come in less than expected, is that the market will not react as much when it comes to lowering the yields or raising the prices of U.S. Treasuries. Why is that? Well, two reasons. One, tariffs. President Trump just announced a 25% tariff on imported steel and imported aluminum. I think that will have a significant offset on how much bond yields may come down if these inflation numbers are better than expected. Number two, U.S. government spending. While Elon Musk and his Doge department is finding all sorts of what we might describe as unneeded U.S. government spending, there is still a problem with the Congress. They have not been able to come up with a budget yet for the year. And the likelihood that there would be significant budget decreases or spending decreases within whatever budget they may come up with, I think is extremely low given the makeup of the current House at the moment. So I think that those two factors will help offset any potential big decreases in U.S. bond yields. That's my personal opinion. Now, if I was someone who wanted to guarantee that I might get a 4.5% US Treasury note, then I might be buying my US Treasuries today. However, many of you know that I'm not touching the 10-year Treasury note until it hits at least 5%. More than that, really. I'm looking at the 2-year Treasury note when it gets to 5% to buy that. So what am I doing? I'm not doing anything. I'm just sitting tight and watching. That's going to wrap it up for today's video. If you have a counter opinion, please leave that in the comments. Or if you feel like I didn't quite include enough or I misstated something, please leave that in the comments as well. Until next time, enjoy your investing.